Good evening. Tonight we are pleased to report that it continues to be a good time to be an equity investor in America. We believe in the American economy and our system, regardless of who goes to work in the Oval Office or the Capitol. 11 years ago, during the Great Recession of 2008 and early 2009, when Obama was first elected president, some of our clients were very concerned and urged us to get out of the market. We advised against this and explained that we believed the market was close to flushing out a bottom in stock prices. None of us knew exactly when that would occur, but we believed that many of the companies we owned would be generating record profits in 3 to 5 years and would increase their dividends. That's what happened. But back then, some investors panicked and sold their stocks at severely depressed prices. We encouraged our clients to stay the course, and they did that and were rewarded for doing just that. Just 3 years ago, when Trump was elected, other clients were concerned and urged us to get out of the market. Again, we advised against this. Our clients accepted our advice to stay the course and benefited significantly. Going forward, our view is that the companies we own will continue to grow and generate higher profits and increase their dividends. Every year, we believe it's important to remind you that the key components of our investment approach focus on a company's fundamentals, such as its price to its earnings, its PE, its price to its book value, its prospects for growth, whether it has a strong franchise or a wide moat, its free cash flow, the quality of its management, and whether it has high returns on equity and invested capital. Many companies with high returns on equity and invested capital have a strong franchise or an economic moat. By that we mean that they have a sustainable competitive advantage that keeps competitors from attacking their profits and their market share. There are different types of moats, many of which we have discussed at previous forums. Drug companies, for example, which own key patents, have an economic moat. A powerful type of moat you see a lot of today comes from creating a network effect. Google, Apple, Microsoft, and Visa, companies we own, have this type of moat. As more people use their services, they get larger and stronger and have the potential to generate more profits. We own diversified portfolios for our clients containing both value and growth stocks. Tonight I will briefly discuss two of our stocks, one with a low PE, a value stock, and another with a high PE, a growth stock, and explain why we own both. The value stock is Delta Airlines, which we started purchasing in March of this year. Delta is a $35 billion company, and its stock trades for approximately 8 times its earnings, which is less than 1/2 of the market's PE for stocks in the S&P 500. And Delta has a 2.6% dividend yield, which is higher than the yield on the S&P 500. Delta has experienced management that wisely deploys its capital and improves its earnings. However, Delta does not have an economic moat. No commercial airline does in this very competitive market. But Delta has its major hub in Atlanta, which is the busiest airport in the world. And in Atlanta, Delta has over a 70% market share. And by dominating this, Delta gains unmatched benefits from connecting this hub to the rest of the country and the world. In our view, Delta is reasonably priced and is an attractive long-term investment. Next, Microsoft, a growth stock. Microsoft is our largest holding and currently sells at 27 times forward earnings, a high price-earnings ratio, which we believe is fully justified. Microsoft is the largest publicly held company in America with a market capitalization in excess of $1.1 trillion, that's trillion dollars, and it's one of the few companies in the world with a AAA credit rating. Since Satya Nadella took over as CEO in 2014, Microsoft has had a remarkable renaissance driven by his full embrace of Azure, its cloud computing business. Microsoft's cloud computing business grew its revenue by 72% this year, and this strong growth is expected to continue in the future for many years. Microsoft has a deep and a wide moat and should continue to be profitable in future years, protected by its patents and a vast network effect from its interconnected businesses. It is no surprise that Microsoft's stock is up 45% this year and again has increased its dividend. We expect Microsoft will perform well over the long term. And now let's take a look at the current state of the stock market. We have not had a market correction this year. A correction is a decline of 10 to 20% from a recent high, and a decline of greater than 20% is called a bear market. In 2018, we had two corrections, the most significant one in December of last year. After both corrections, last year the market promptly regained the losses. Now, corrections typically occur about once every year or two, and since we have not had a correction in 2019, it seems likely we will have a correction over the next year or two. But we would expect the market to again regain the losses from the correction within a few months. Our last bear market was during the 2008-09 Great Recession, and we do not see signs of a recession or a bear market at this time. We are well aware, though, that there are challenges confronting our economy and the stock market. These challenges include difficult international trade issues, especially the trade war with China, our massive federal deficit, dysfunction in Congress and the administration on important fiscal matters, geopolitical tensions throughout the Middle East, and ongoing Brexit concerns. Although these threats to our economy remain, in our view, the positives outweigh the challenges for investors. The positives include, first, general economic conditions in the U.S. continue to improve. The recent jobs report showed steady improvement in employment, with the unemployment rate now at 3.6%, the lowest in 50 years. Private sector wages continue to grow. The average hourly wage is now more than $28 an hour, a record high. Consumer spending continues to be strong, and consumer confidence remains at favorable levels. The yield curve is no longer inverted. All of this is good news. Second, as of today, the S&P 500 is up close to 24% this year. The price-to-earnings ratio of stocks in the S&P 500 is slightly above 17 times forward earnings, which is close to its long-term average. However, the stocks in Edgemoor's portfolio are selling at slightly above 15 times forward earnings, which represents a discount from the overall market. In addition, corporate earnings are solid. In the past quarter, 75% of the S&P 500 companies have beaten their earnings estimate. Next year's earnings are estimated to be 11% higher and set another record. Market valuations tend to follow earnings. But it is not just the U.S. stock market that's performing well. In fact, the stock markets in Europe have returned over 20% this year, and the Asian markets have returned over 12%. These markets are available at a discount to the U.S. market, and we have been buying into these markets. Third, on October 30, just 3 weeks ago, the Federal Reserve cut interest rates by 0.25% for the third time this year, reversing nearly all of 2018's rate increases. Its reasoning was that Fed rate cuts were necessary as insurance because of uncertainty about how the economy would handle the trade war risks. Chairman Powell also announced then that interest rates are now on hold unless there is a material deterioration in our economy. The impact of Federal Reserve rate interest rates cuts on the economy is felt most significantly 6 to 12 months after the cuts have been announced. Therefore, the economic stimulus from the recent federal rate cuts should continue well into 2020, which should be a major benefit to our equity markets. Fourth, finally, and important to us, high-quality stocks are available at attractive prices. We do not have to pay a premium to buy powerful cash-generating companies such as Bank of America, Apple, Medtronic, General Dynamics, Novartis, and others. These companies are available at a discount to their intrinsic value and pay dividends that grow over time. We expect the stocks we own will provide solid returns over the next few years. Our next speaker is Paul Meehan, who is a managing director at Edgemoor and a chartered financial analyst. His focus is on income investments. Thank you.